Okay, the important thing is by asking this one question, the candidates were getting tested on all possible parameters. Number one, they were getting tested on whether they're good in Excel or not. Okay, so how are their Excel skills? Second, how good is their fundamental understanding? Whether they are in a good position to understand the overall dynamics of the transaction. That is, can you formulate the structure into your own model? So they were testing their fundamental skills. Third, the task was to be completed in 4.5 hours time. If any new person begins with a leverage buyout's complete understanding that what this transaction looks like and starts to prepare the model from the base, in spite of having a good Excel skills, will take at least 7.5 to 8.5 hours to finish that model. But they were asked to do so in 4.5 hours. You can only do that if you're very good at Excel and if you're already built in few leverage buyout models. It's not possible if you don't have any practice of that in past. They checked its fundamental skills, the speed, the Excel skills, and so on and so forth, as well as the temperament. How quickly, if you're given a time limits, which is very important in investment banks, private equities, and so on and so forth. So it's very important in these companies or bulge bracket investment banks that you should finish your tasks in time. So they test their temperaments as well. What we are looking at, what kind of positions that we are looking into financial modeling, the careers basically. If I were to describe my own experience, I'm an ex-UBS investment banker. I used to deal alongside managing directors and so on and so forth. Whenever we used to work on transactions in Fortune 500 companies, and we used to typically work on any transaction which was about 500 million US dollar. So I'll give you my own experience. From the starting level to the level of the MDs, it was inevitable to have the knowledge about financial modeling. Because when you're starting there, you're doing that modeling on a day-to-day basis. But when you're at an AD or ED or MD level, you have to understand that model in less than 30 minutes. Because that's the amount of the pressure you have for closing the transactions. You're looking at models on a day-to-day basis. So if you don't have the speed, you cannot comprehend it in less than 30 minutes and find out if there are any mistakes and so on and so forth. The team with which you used to work, the MD used to point out the mistakes in less than 15 minutes, if there was any in the financial model. So that's how quick and fast you have to be. So these are some of the positions, say managerial level, project manager, equity research analyst. You're looking at hedge funds, pension funds, investment banking, regulatory finance, risk management. So all these areas use financial modeling. There's not even a single area, even if you're talking about econometrics or quantitative finance, that is the purely technical side of, say, finance. So in those cases also, you'll always find that financial modeling is used to the core. You're bound to have, I mean, it's inevitable for you to have the knowledge of options and so on and so forth, how to deploy them when it comes to the cash flow series. So it's getting used at every level. Now this is on an average salaries which we see for the financial modeler, which is exclusive bonus. So we're looking at 85,000 to 100,000 US dollars. On an average, it is 85. On a lower side, in some of the Asia Pacific region, it goes to 65, 70,000. We're looking at 80 to 90,000. If you are with a prior experience, you can easily look at 125,000. So this is 30% higher than the person who is hired at the similar level but into a different stream. That is not in finance. So for example, you're comparing a manager in operations. You would draw at least 25 to 30% lower than what you're drawing. That's the kind of the difference a financial modeling can make onto your career. But if you're selected in any IB and you're not good in Excel, then there are good chances they can even drop you down. That's the state. The IBs these days, or the securities firms, or the pension or the hedge funds, are hiring people with the available knowledge, already available knowledge. If you have that in advance, it's a very good chance of increasing the space to the higher amount with the course which we are offering. Now, what's the BFSI's outlook in Singapore? We are observing a very good hiring activity since last 12 to 18 months. This will continue for at least another 16 to 18 months. That is 5 quarters to 6 quarters at least. There is a good demand in the BFSI sector for the candidates who are operating from Singapore. So especially in the insurance, in the investment banking, private equity side, and securities houses. Because Singapore is not just doing or allowing the trading onto their bourses. They are allowing the trading for international bourses as well. It's a demand from international investors as well. Being a financial hub, they attract a lot of capital, and they are continuing to do so. So Standard Chartered, HSBC are taking leads onto this side. So you'll see a lot of hiring into this space. We are looking at average salary hikes of 7 to 10% year on year. When I say 7 to 10%, it's combined basically all the sectors, subsectors of finance. So some of them can look at even 20-25%. Like structured finance, which is very much in demand, which we are very good at, and so on and so forth. You can look at bonuses of around 20 to 25%, on the higher side up to 40%. So at 90,000 Singapore dollars, or we are looking at on an average pay from an MBA grad, non-Ivy League. And there is a demand for specific sectors like risk management. Why? If you see the current CEO of JP Morgan, that is Mr. Jamie Dimon, he's primarily from the risk background. He's very good in risk management. That's why JP Morgan, which was lying at a 4th and a 5th position before 2007, and they ended up being the first bank. Okay, before 2007, the likes of Citi and BofA, Bank of America, were on the 1st and 2nd positions. But post 2007, all these banks have took the major hit except JP Morgan. The companies are these days looking for the risk cum finance managers, not just finance managers. That's what the Singapore's market is all about as well. If I'm sales and accounting in this sense is strictly on the lead generation side. When I say lead generation, means you are in a deal origination stages. There are various stages of doing any transaction. If you're in a securities house, it's for how do you tap the HNIs. If you are into investment banking, the deal origination is whether this company is looking to raise for funds or looking for acquisitions and so on and so forth. So this is what it is when it comes to sales and accounting. Audit and tax and risk management, these are another areas. That is the regulatory finance, that is audit and tax, risk management, that is purely on risk management side, and sales and accounting on the front end finance. All three wings of the finance require the understanding of financial modeling. So there's nothing that is left where we don't deploy financial modeling. It is the inevitable part. It's the part which has not been said specifically, but when you enter into the corporate world, or if you're already done, you will recognize very well with this that if you're not good in Excel skills and so on and so forth, your growth is restricted. Not just that, sometimes we have seen people being expelled as well. Yeah, so financial modeling is the base, and all three areas require these skills. Now, these are the pages that we are looking at from the equity research, investment banks, and risk side. As I said, there's a lot of demand from the risk management area. As a result, you can see the directors getting paid highest if they are from the background of the risk management. So there's a high prudence when it comes to commercial banking, investment banking, or regulatory finance. So as a result, we are hiring directors which are having the background on risk. The VAR, value-added risk, the GARC, and so on and so forth. So to people with such backgrounds. And of course, we have equity research and investment banks also drawing higher than what the managers or the associates would command in a fields outside finance. Okay, so there's a good pay out there as well. So these are some of the companies which are hiring in a good pace when it comes to Singapore: Aero Capital, CS, HSBC, Xiom Capital, Barclays, Deutsche, and Standard Chartered as well. The name is not mentioned, but we know quite a few bankers from inside that space, and they are on hiring spree as well in selected departments. Now, We look at one model currently that is to give you a feel of how does a financial model looks like. This is prepared by our team, LinkedIn Corporation IPO. So we have prepared a complete model on the expected when the IPO is about to come for the LinkedIn. We look at what kind of tabs we have. So you understand we have summary tabs, ratio analysis, assumptions, revenue build-up, cost build-up, asset schedule, equity, due point analysis, profit and loss, balance sheet, cash flows, ratios, valuation, trading comparables, football field analysis, and so on and so forth. I know for the fact that if I were to look at the company's revenue year on year, okay, I'll straight away jump to profit and loss account. So this is what elusive means. Naming the tabs properly, having a clear demarcation. So I haven't combined the assumptions inside the profit and loss account. I kept them separately inside a revenue buildup. So these are my assumptions. What is the expected growth rate of the registered members year on year, that is post 2010. This is the expected growth rate quarter on to quarter basis, and the overall impact is shown in the profit and loss account in terms of revenue. So this is hiring solutions. This has been derived from my revenue buildup, and this has been further derived on what's the revenue that I'm going to command from that particular year, and so on and so forth. So that's how simple and straightforward any calculation has to be. For example, we look at revenue buildup. Now revenue buildups and assumptions would change based on the sectors. If you're looking at a mining company, it would be completely different. If you're looking at a company which is into real estate, it would be completely different, and so on and so forth. So all these sectors have got different valuation methods, different build-ups, but the base remains more or less same. The crux or the idea of how does a evaluation should look like remains same. Only the parameters and drivers would change. Okay, so in the same way, I'll forecast the revenues of a mining company as well as the expenditures. So they are LinkedIn is present into hiring solutions, marketing solutions, premium solutions. And we have assumptions for balance sheets. Now, the assumptions again are kept with the dynamic buttons. That is, I can change the method. That is whether I should use a scroll bars or CAGR when we are talking about accounts receivable. So if the moment I change it to scroll bar, all the calculations would change onto the CAGR. So I can use this to change the percentages. So that's how simple it has to be. The moment I change this, the final value should change. And now we look at each and every tab so as to understand how this particular model looks like. So we have revenue buildup, cost buildup, the cost of revenue, SMM, product development, general expenditures, depreciation for the assets which we are adding, and so on and so forth. Then we have asset schedule. This is to be prepared based on the requirements. If you're working on a mergers and acquisitions model, this would be prepared in a different way. If you're working on a project financing company, it would be done in a different way. We'll have interest during construction and so on and so forth. We have kept the life as well as the overall additions which you are having. Now, equity would include all possible structured products which are probable for their conversions into equity. For example, if I have got in-the-money options being issued in form of an ESOPs, okay, employee stock options and so on and so forth. So those would get converted. What would be the conversion ratios and for the convertible preferred stock, for the convertible debentures, if they are in the money, those would be represented into this particular sheet. So this would give you an idea of how much diluted shares outstanding we have for LinkedIn at the end of each year, starting from FY07 and ending on to FY15. Once we are done with basic profit and loss and balance sheet, profit and loss specifically, then we'll draw down this due point analysis. So we learn in the class how to do this, how to form this in form of charts, and so on and so forth. So this would give you a clear-cut idea of if somebody has to look at what's the distribution of sales and expenditures, what's the direct impact on net profit margins, how does my leverage looks like, what are my total liabilities, the asset turnover ratios, and so on and so forth. So a complete leverage multiplier and ROE. All this would come through a 2-point analysis. So if I ask someone to look at this particular sheet and tell me about LinkedIn, we can get a lot of idea from this. Now finally, once the revenue buildup and cost buildup is done, we'll translate them into our revenues and costing into a profit and loss account, a summarized format, a neat and a clean approach. There should not be any misrepresentations or calculations being done here. These are all drawdowns. Now you would have observed there are two colors for the numbers. In black you would find the formulas, and in the blue you would find the numbers which are inserted. So this kind of conditional formatting would be learned so that you're in a position to see if you have to change anything, you can do that. You don't have to go onto these numbers if you would like to change something. For example, if you want to change the growth rate or hiring segment, and so on and so forth. In the similar fashion, we'll draw down our balance sheet. It would include the current assets, liabilities, working capital, the fund-based limits, the non-fund-based limits, the expenditures of bank guarantees, and LCs, if there are any, would be drawn down onto this. And finally, we'll prepare a cash flow statements, which is very important when we are comparing few sectors, how much cash they're generating, how much is the cash operating profit margin, okay, which is different from your general operating profit margin. So we look at these, say, cash operating profit margins in various industries, because you can manipulate the method of depreciation, but you cannot manipulate the cash flows that you're generating from the operations. So that's why it's important. And finally, we'll get all this into one format of ratios, that is profitability ratios, the return ratios for the capital which we are deploying, for the equity capital as the debt capital, and activity ratios and leverage ratios. Finally, we are looking at the most important thing, which is part of every financial model, the valuation. So here we have used FCFE, that is discounted cash flows method. There are various methods for valuations. We have discounted cash flows, we have got options valuation, we have got precedent analysis, which is based on the transactions done in the past. We have got comparables, trading comparables, which we use in the industry. So I'm talking about these methods which are getting used in a league, IBs, and private equity firms across the globe. Okay, so these are the prominent methods which we are using. So we'll do the discounted cash flows for LinkedIn, and based on that we'll find out its value. Now here we don't have any debt, so we can find FCFE or we can find FCFF as well. But in the case of a debt-ridden or captive companies where debt is really high, in those cases FCFF becomes important equally. Now, this is trading comparables, the comparables method that I talked about. So this is another method. Now, in comparing LinkedIn with how Google and eBay and Amazon forayed during that particular year, that is, what was their P by E ratios, what were their P by book value ratios, what were the enterprise value by EBITDA ratios. Using these ratios, we would arrive at a value for LinkedIn. So we use the multiple for EV by EBITDA, that is a mean, and we use the EBITDA for our company, that is LinkedIn, found out the enterprise value, and finally got the share price. Okay, that's what we got through the FCFE method. So we are looking at 31 and 66 through EV by EBITDA, 26 and 62 by P by E method, 23 and 29. Why we are doing multiple methods? The answer is really simple. There is no one method that can be applied to any sector. For example, I cannot apply P by E, that is price by enterprise value, or EPS, okay, price by EPS, be it 1 year forward or 2 year forward, to banks. In banks, I'll rather look at price by adjusted book value. I'll look at what is the ratio of NPVs to my equity. Okay, so those ratios will get deployed in banks. In metals and minings, I would look at price to NAV. Okay, so what is NAV? The asset value of the mines that I'm holding in based on the probable and proven resources there. If I'm looking at a real estate, I'll look at purely the discounted NAVs, okay, for the projects that I'm deploying and how much cash flows I'm expecting, and so on and so forth. So if I'll deploy these various methods, we'll finally present them in one chart. Okay, so all the methods. So we have got P by PV, we have got P by E, and we have got EV by EBITDA in football field chart in one shot. Based on this, the negotiators, that is, the directors and managing directors, etc., who are negotiating onto a transaction, they decide onto the pricing. Okay, so there are negotiations based on various methods because you cannot just apply. For example, if I'm negotiating it from LinkedIn's perspective, obviously I will select EV by EBITDA and try to get it a value of 65.6. But if I'm discussing it from the investor's perspective, I look at a value of 22.8. The least I pay, the better it is for me. So the negotiation is to be done onto the lowest and the highest. Of course, you never command the lowest or the highest. You command somewhere in between. Say, for example, in this case, 31 or 32, like that. And once we are done with the complete model, we'll have to represent it through two charts, which can change based on the sector. So I'm looking at a ratio analysis. Now it's again a dynamic chart. Suppose if I'm discussing the transaction with one of the investors of LinkedIn, and I want them to invest into LinkedIn during their IPO. Say these are European investors or investors from Middle East. Obviously, they would ask a few questions like, what kind of returns we're looking at for investments? So we'll simply click this and show what kind of returns we are expecting over the next 4 to 5 years. If they ask us about how much is the leverage this company is going to take in, or how does the liquidity position look like, then we'll click onto this. If there is negotiation onto the profitability ratios, we'll click onto this, and so on and so forth. So this would give you a complete idea of how the ratios are looking in one chart. So preparation of these charts also part of these sessions. And finally, the most important one is the valuation. So how do you present a valuation in a form of a charts? So I can look at a premium subscriptions and how does my stockholders' equity increase year on year. I can look at how does my premium subscription looks like with a profit before taxes. Or if there are, say, negotiations onto stockholders' equity and cash equivalents, how they're going hand in hand, or it's just that my equity is increasing but cash is not. So that would show me that I'm deploying these cash year on year somewhere. And if there's a decent cash available, then we can look at some sort of dividends in the upcoming years. We can put pressure if we are holding a decent amount of stake in the company. So based on these, you basically chart out your final summary. So this is how your summary for LinkedIn would look like, or this is just one example of how does a financial model look like. So a financial model in a project financing infra company would differ. Financial model for metals mining company would differ, but its core would remain the same. The financial model for a bank or in IT as well, that is, say for example, Accenture or IBM, would be developed in a different way. Okay, so we are looking at all possible avenues out there. We'll give you some ideas about what these classes would look like when we are talking about Singapore, our financial modeling classes. This is a perfect course actually, because we have seen how it functions inside industry, and the majority of the people, in fact all of them who are going to deliver to you in form of a sessions would be from industry itself. So we have very healthy knowledge pool. Highlights would be 4 full days of the classroom training by the industry experts. When we say industry experts, means from the industry who have prior experience of building these models. A full 20 hours video tutorials which you can switch on to at any point of time if you are having confusion in any particular parts. Sample financial models, example workbooks, PDF guides. So you'll get a lot of models to work upon so that you can understand the difference between sectors and so on and so forth. Unfilled and filled Excel templates, 24/7 support for the doubt clearing, and of course we are approved by GARP and CFA Institute for the CE credit hours. Now, what are we looking at from financial modeling classes? If you are done with that, you will be in a position to create these kind of models in an easier and a quicker way into an Excel. Not just this, you will understand a few of the quick techniques of how to use shortcuts, toggle between sheets, find out the mistakes, if any, in the model very quickly. And if you change even a slight one number there, that is the growth rate, your whole model would be dynamic enough that you'll get the final valuation. We had seen the people who hadn't got any experience in financial modeling and joined in investment banks when they formed the models, when we asked them to change some numbers, they had to change the complete model. So that was not a dynamic model. We don't want a waste of time when we are talking from the employee's perspective. So it has to be a dynamic model. That's what you will learn. And you will prepare the error-free Excel reports, build it in a better way and a quicker way, a complete understanding of what goes inside and how financial model is used, the shortcomings of financial modeling, if any, understand design principles basically. That would show your work to be quite say well or better in front of many other candidates. It would be natural. You won't have to strive hard for that basically. Now these are the details of the batch which we are going to start from 22nd February to this year. And there is 2 days exclusive class and there is a 4 days master class. The costings are given. The contact person is John Komechi, and Mr. John is the one who is going to give you the further details. You can note down these numbers and email addresses and so on and so forth. So you can contact them for any further queries, etc. Now, few details about us, that is EduPristine. We have trained more than 10,000 finance professionals across the world. We are authorized training provider for international certifications like CFA, FRM, PRM. We are offering more than 25 hours courses through classroom trainings, online videos, question banks, crash courses, webinars, etc. There's more than 1 million man-hours of training that has already been conducted in more than 40 plus locations with more than 40 plus nationalities. We are spread across the globe basically, to say the least. Our investors are SL Partners, Dr. Mark Mobius, the giant in the bond markets. Everybody is aware about him, from Franklin Templeton and Mr. Rajesh Sehgal as well. Founding directors, Mr. Atul Kumar, Prandeep Singh, and so on and so forth. We have a direct experience of training in Goldman Sachs, Standard Chartered, Accenture, S&P, Reliance Private Equity. So these are the companies where we have provided the training through approvals of the corporates, okay, not just outside. And there are various Fortune 500 companies, organizations which are associated with us for taking these trainings. There is a clear-cut demand for candidates which are having good fundamental and financial modeling understanding. So this is what EduPristine does. It bridges the gap of understanding of modeling. Now, these are the associations which we are having: CFA, GARP, FPB, Premier. Some of the companies where we have already provided the training, as I stated: E&Y, Big Four, Real Estate Modeling in ING Vyasa, one of the giant insurance company, Infrastructure and Project Finance, Franklin, Templeton and CFAs in HSBC, Risk Management, in Mezzoa, Financial Modeling in Excel. These are some of the premier institutes like ISB, IIM Indore, IIT Delhi, where we have provided our trainings. Now, this graph would tell you where all we are present basically. So we are present in North America, in Latin America, South America. We are present in a few countries from Africa, in Australia, New Zealand, almost all major countries from Europe, and in Asia as well. That is Russia, Hong Kong, Singapore, Japan, India, China. These are the locations we are present. Now, these are some of the topics that we cover across the board when we are talking about EduPristine. We cover all these topics, all these different courses. Basel III norms, which are getting implemented. In the first week of the January, second week of January, HSBC started implementing it into its branches inside Asia. Analytics, CFA, FRM, PRM, alternative investment, business ethics, quantitative analysis, economics and markets, reporting, corporate finance, portfolio management, investment banking, IPOs, and so on and so forth. Thank you very much. If you have got any questions, I'm sure a few of you have noted down already, and if you have got any further questions, we'll try and answer them one by one.
Thank you, Ravi, for the insightful thoughts. If anyone wants to ask any questions from Ravi, please post your questions on the question tab. By that time, Ravi, if you can add something about your experience.
Sure. Certainly. So, if I'll give you like my own experience, basically, we have negotiated on quite a few of transactions, and we have worked with a few of the KPU firms on how their structure should be while they were forming. So we were looking at their investment cycles. That is, the new KPU firms were coming in. They were hiring CFPs and CFAs and the MBS from a premier insurance. Now, the first thing which we talked about is there's a lot of turnover in BFSI sector of the employee. Now, the reason which was found out is for two things. There was the turnover, okay, of the employees in various companies, but that turnover was of the top 20% chunk only. So that was why? Because there was a poaching which was happening, because those 20% were so good in these various companies that they were getting offered a higher and a higher pays back to back. And we have seen a rise in a pays to the extent of 3 to 4 times in a span of 5 years. Yeah, so we are looking at, if you're starting at 100,000, you can end up at 300,000 or 350,000 in a span of 4 to 5 years. And the thing which differentiated those candidates, basically, those few candidates, was very clear, that they were very good in interpreting the data that was given to them, as well as they were very good in giving the data based on the structures, that is, in form of the Excel sheets. So they were really good in doing valuations, using Excel sheets, and so on and so forth.
We have a question for you.
If you have any questions, if you'd like to. Sure.
Yeah,
yes.
There's a question by Dave. He wants to ask, is there any prerequisite for financial modeling?
Prerequisites for financial modeling? No. There are, as such, no prerequisites, but what do we expect from the candidates which are joining is to have the basic idea of the Excel. That is, if they are decent enough in Excel, that is the basic idea, basic understanding. In that case, they will gain a lot from these classes, because they will be in a position to do quicker and do more models than what anybody in the other case scenario would do. So candidates who are already working in a corporate scenario, or the candidates who are currently pursuing their masters or PhDs, can easily join in. So there's no such prerequisite.
Anyone else who wants to ask any other kind of questions? There's one more question from Dave. Ravi is asking, if someone who's not from typically financial technical background, how this masterclass can help them?
Sure. So if you are not from the finance background, say you are from the engineering background, or you are from the regulatory side, you're from finance but on the regulatory side, not from hardcore investment banking or PE firms based experience. In that case, the basic accounting knowledge that you would have got into your high school and so on and so forth would be used to hone your skills basically, as well as sharpen your understanding of the fundamentals of various types of transactions available and so on and so forth. So if you are not from the core finance background, but you are from, say, financial operations background, or if you are from any other background, in that case, these would help you in the way that you can use it into your own fields as well. If I'm into an infrastructure company and onto the project manager level, the project manager has to look for all the things. That is the kind of the procurements they're doing, how the project has to look like, what are the investments going to be in, and so on and so forth. So they have got the good infra background, but they haven't got the core technical finance background. But if they go through how does a project finance model looks like, they'll be in a position to help themselves find out if there are any flaws in what they are getting assisted with, the kind of the numbers, etc., and so on and so forth. So at the end of the day, they would be benefiting themselves clearly.
Thank you, Ravi. Is there any more questions for us? I think, Ravi, that's all people have questions for you. Yes, one more question for you.
Sure.
How someone can land up to associate level position in MNC bank without experience and just with this masterclass?
As I gave you one instance, if you can recall, the interviews were getting, say, they were taking up the interviews in one of the top 5 private equity firms. So the interviews were for the entry level, say, associates. Now there is a difference. In securities house, associates are placed on the lower side and an analyst is on a higher side, and an investment banking analyst is on a lower side and an associate is on a higher side. So there's a difference. You'll have to understand that, and it's across the globe actually. So if I'm looking at the associate level in IB, basically, we have seen a few instances where they were hired at the associates level, provided they had very good fundamental understanding, as well as they were from a very good B schools. If you are from a medium or a lower league, basically B school, you'll have to take at least 1 or 2 years of experience along with the financial modeling class to go on to the associate level. So if you're taking up this and you have got a good background and understanding of financial markets, which can be reflected through your degree, then it's a very lethal combination. Then you are actually done the thing of 6 months in this class itself, because if you're starting from scratch inside an IB, it will take you 6 months just to understand how does models here are working. That's it. So that 6 months are being brought down to almost naught. That is the amount of the days that we are going to take. And then based on this accreditations and certifications, you can clearly bargain for the position of associate. I hope it has answered you. If there is any specific query built up onto that, just let us know.
Ravi, there's a question from Paul. He wants to ask any other books where he can get the idea what this financial modeling is all about. Perhaps he want to understand what is financial modeling before he come aboard with us.
Okay, sure. See, the way I showed you one particular model for the LinkedIn, this is how the modeling would look like. But I'll suggest you what you can do is there are a few financial models of previous companies, say, I mean, you can find it for, there is one model available inside the pitch books for Merrill Lynch. There are 1 or 2 more models available onto the web for those companies, and you can find it out for Merrill Lynch, you can find it out for Bear Stearns. So their pitch books and models are available, 1 or 2. Frankly speaking, the models cannot be made public because they are part of the IBD barriers. That is, you cannot disclose these details as these are privy to only select few. So you can look at historicals, that is not an issue, but projections are always an issue. Okay, but if there are any previous models, say of 2006 and 7, you can look at them. You'll find that for Bear Stearns, Merrill Lynch onto the web, and you can refer those models. Sometimes you'll just find the models for dummy companies, that the companies which are not existing. You can take a look at them. So it's basically, if I were to give you in one go, or say, if you are entering into a commercial bank or an investment bank, modeling is the bread and butter. This is what you'll have to do on a day-to-day basis. So if you're good in modeling, you'll use that model and use that into a particular pitch book. So a pitch book is a complete book, or say a pitch which we use to negotiate a transaction. Okay, so that pitch contains all the, say, gist and the models of that particular company.
For you?
And of course, onto our website, you will get a lot of data about financial modeling. So you can get some more data from our website, from EduPristine as well.
Yes. So one more question from Muhammad. Do we cover any other tool beside Excel in this course?
Beside Excel, when we are like PowerPoint presentations and Microsoft Word, if you're referring to, we use PowerPoint presentations, but we don't, say, use them for doing modeling or writing down things. See, please understand, we are using Excel. This class is not for learning how we operate Excel. Okay, there is a difference. We are expecting that the candidates will have basic idea. Okay, if not the advanced level, but at least a basic idea how does the Excel work. So if that is there, we'll use that and build the models onto it. When it comes to Microsoft Word and PowerPoint, we actually use them for reports and presentations, which we are not going to prepare inside a financial modeling class. So it's primarily about Excel. Yes, once this Excel is formed, it is used very well. We can select some of the excerpts. Say, for example, I can select a valuation tab completely, copy it and paste it inside a PowerPoint presentation. So that's how we'll use it, but not for the but we'll not do any kind of report writing or pitch book formation into these classes. I hope it has answered, Moment. Any other questions?
I guess we are done with the question and answer session. Thank you, Ravi, for your kind time. Thank you.
Great. Yeah. All the best, everyone. I hope you'll be enrolling into, because believe us, there is this would bridge all possible gaps when it comes to a 2-year experienced investment banker and a one who has started it recently. So this would bridge all the gap in no time. Thank you very much.
Thank you, Ravi. Attention all, we have a 30 days trial period on our website. If anyone wants to know more about the course, can go there, and it's for free of cost. If you have any questions regarding that, I'm happy to answer. Thank you everyone for your kind time and patience. Thank you.